Welcome, everyone, to another edition of the Tony Sirianni podcast. I am thrilled to be here with my good friend Tim Bello. Tim, welcome to the show.
Tony, how are you, man?
I'm very handsome today, which is great. Tim is a managing partner and he's also a co-founder of Merchant. And is it Merchant Bank or what should I be calling it? Merchant
How do you know the answer to that question?
Capital?
It's one word. It's merchant.
Merchant. I like that because like share, it's like share, And some people have had like such influence in the world, share being one of them, that they can just go with one name. And I think not. I'm not trying to be funny. I really think Merchant has had that kind of influence on our marketplace, the advisor marketplace, because of its innovative financing solutions and all that, which we will get to. But what I want,
Interesting to bring it up if I can just comment on
yeah,
it first. So in the
sure.
beginning, um, Scott Prince, Mark Spilko, Rick D'Amico, Brian Staff, Dave Mrazek, myself sat around the table and we debated, you could call it that, beyond the word merchant, what should it be really called? What should it be known as and why? And we have names within the company and on the org chart for the structure of the businesses, Merchant Wealth Partners, Merchant Investment Management. But one of the things that I did say, and we all agreed on, is together, let's build a business that has enough stay power and impact in the market where somebody says one word and they understand what it means. And so it's interesting you started our conversation there because the word merchant, we like to start and stop there.
Yeah, look, I agree. I think it's very cool. Well, let's talk a little bit about because it has had a tremendous influence, on our marketplace, advisor marketplace. But let's talk a little bit about some of the trends you see forming now. I mean, the spate of change. It's been constant for the last 10 years, and it's interesting. I think advisors are curious about where you see it today and where is this going to lead us, tomorrow.
You can start. There's a whole bunch of different groups, right? You can start with clients for starters, right? I mean, the clients have been educated in a way where it's kind of come full circle, frankly, right? If you roll back the clock, decades, perhaps hundreds of years ago, if that makes sense, or if that's accurate, you had the single family office concept, right, where people were, institutionally covered clients of the street, right? They could go anywhere, they could get anything, and then you had this rise of these big institutions, and then people and advisors went in house to the institutions. I think now you're just continually moving in a direction like it was in the beginning, where you have these, financial services companies. I don't even know if we should call them RIAs anymore or practice.
I'm in total agreement on that. I think it's more RIA has become more of a an aspirational, set of ethos of where you believe in these certain things, and that makes your firm, that way. And so within that realm of we believe in all this stuff, there's a lot of choices and a lot of different types of firms, and they could be firms like look at Wells Fargo. I mean, that's not a wirehouse anymore, you know.
And I look, we could go off on a tangent about the definition of a wirehouse. I mean, I think you just have these small, large, and really massive financial institutions, right? And look, we could also go down the road of independent advisors who started out with practices. Those practices became businesses, and those businesses became financial services companies, with multiple lanes of business unto themselves. And so you've seen this real evolution. Like I remember back in the day when we started Dynasty back in 2010, we were around a table there in the very early days talking about what the definition of a big RIA back then would be. And it was 1 to 3, and then it went from 3 to 5, and then it went from 5 to 10. Now it's 25 plus. Now you're seeing businesses that probably make us today feel like they are the D.A. Davidsons and the Morgan Keegans and the E.F. Huttons of the future. And they're right here. They're present in front of us. These are companies that have enterprise value in some cases at or around $1 billion into themselves. And I remember sitting around a table years ago. This is when like the prop desks were at the height. And a bunch of my buddies who were running a few of those desks kind of shook their heads when I said to them, hey, like the RIA space is budding, the independent space is budding. But at the same time, Tony, they were also back then calling financial advisors salespeople, right?
Right.
So the whole mindset has shifted for the client, for the advisor, and then for the capital, because there wasn't a lot of capital coming in. And then, there was this whole rush, and now there just continues to be this wave.
Well, and so I do want to talk about the capital and kind of where you see it. But you mentioned some of the stuff about sort of beginning the business and when you first got. Tell us about the sort of origin story of Merchant. How that came about.
Yeah, I mean, there's two lanes to the answer, right? One is the scientific answer, right, which is like, what did we actually do to actually start the company, and how did that get going?
Yeah.
It's like with any business, right? There's always these elegant stories. The reality is a bunch of friends that have known each other for a really long time, decades, people that have shared the Thanksgiving table together, wives of friends, kids of friends, godparents of each other's children. We got together and said, you know what? We all want to run in the same direction towards building something that's built to last, not built to flip. And we think that the best lane of the financial services industry, this was back then, and we still believe it clearly today, is the business of people, which is not a trade, but a business of people, which is wealth management. And
Yeah.
so we sat around. I'll never forget it. How could you? Why would you? Almost 10 years ago now, at 767 Fifth Avenue in a sublet. And I think I said this a couple of days ago to somebody, but you're sitting in a piece of in a real estate lease with really expensive whiteboards, markers that sometimes don't work, and no revenue. And that's how the company got started, right? With an idea. And that's the story. It's a very simple one. I also remember the first time that we walked down the street to what used to be First Republic and deposited the first check into the bank account to start the company. And then it was right around that time we named the business Merchant.
Well, I think you're being a little modest about the beginnings of this thing, because the pedigree of the folks that got together to do it in that room is pretty, special. And then the folks that you've been attracting are special. I mean, it's like you said people, but it's high quality people that are good to each other and have a great reputation, and that it's good for a firm to associate with, in my mind, right?
And you want me to touch on it? I believe that there's, excuse me, no such thing as being humble to a fault. And the partners here that started this business are incredibly humble, and you need to be. And so Mark Spilker, who was the CEO of IMD, right, Wealth and Asset Management, GSAM, and the wealth business at Goldman for many years, was one of the original folks here. His college buddy, who was a former partner of mine even before this, a guy named Scott Prince, who's was the co-founder of Eaton Park with Eric Mindich back in the day. Both guys pre-IPO Goldman partners. Scott Prince was one of the original folks in that room around that table with those markers that sometimes didn't work. Rick D'Amico, who's one of my best friends from childhood. Our parents were friends. The brothers are friends. Again, godparents to our kid, to each other's kids. Rick was in the room. Rick actually used to sit on the Merrill Lynch alts desk, and I'll never forget, he had so many options for his career beyond the fact that we're friends. And I remember one day calling Rick and saying, "Hey, Rick, my friend Scott Prince. You should go meet his friend Mark Spilker." And then as time would have it, they end up all getting along. And then there were two other folks in the beginning. Brian Staff, who's a friend for over 20 something years. His family is the founding family of what I think every independent advisor knows to be PKS today. And Brian was the president of the firm up until the day that he sold his position and became a co-founder here. And then Dave Mrazek, who I think most people know he was one of the original architects of Focus Financial as the general counsel there. Actually wrote the S1 to take that company public. Didn't stick around for the IPO, and now they're private. But in any event, he was here to write the first words on the first docs to start our business. And so that was the group that got around the table, and it was totally out of the fact that we were friends. It had nothing to do, and this is what I love, it really had nothing to do with some engineered process where money came in and said, you six or you five should work together. So it happened naturally, Tony, I guess.
It's interesting because you talk about the process, and the original business model has evolved, right? And it's adapted to sort of changes in the marketplace as it comes, because it's not like you were the first guys to say, "Oh, let's be a minority investor in something." But I think you said Merchant, is just known as Merchant. I agree. But it's really closely associated with this new form of financing that was been around for a while, but as applied to the RIA space, it's been really interesting, and that has evolved now into something else. But let's talk a little bit about about the sort of rise of that. Let's take a position in a firm, and look, I think from my point of view, when I started a couple of these things, I used to stay up at night worried about the financing, and then the compromises you had to make to take a capital partner were so great, because then they owned you, and then they owned the advisors and the clients, and it was just it could be a real nightmare.
Well, we're at Merchant, we're creatures of words because words drive actions. You use the word financing a lot, and then you also use the word that we prefer to use, which is capital partnership. You also, when you unpack the words, two of them, capital partnership, there are two words in there. There's capital and there's partner, and people need to make a decision. Do they want a partner, or do they want capital, or do they want someone that brings both, or something that brings both? And so there's a whole discussion to be had there, right? Because, by the way, there's no right or wrong. Different folks. Some people just want capital. And by the way, some people just want to exit, and they want liquidity in the form of cash now. And that's fine. No criticisms here. But for our model, it started out, I think, centered more around art than science, right? Behaviorally, what is a good percentage to partner with a firm on through capital alignment as an exercise that keeps the founder in a position where their incentives drive the best behavior to continue to treat the clients the right way and continue to grow the business.
And continue to be successful. These guys brought it to X level, right? You don't know more than they do about their clients. You want them to run it.
No, look, there's something to be said. I mean, this is I'm not going to get political, but this is the best country in the world. And it's
Right.
the whole of the American dream. And it is what it is. And that's the truth. And it always will be. And wealth management is another example of an industry that allows people who are entrepreneurial to pursue that dream. And a firm like Merchant came into the market not to take that dream away, but to make that dream bigger and better and stronger and longer. And we've done that. Right? We've done it with 120 companies that have, as an important point, maintain their look, their feel, their brand, their energy, and their motivation to do great things every day in, day out, not just for their clients, but for their businesses as well. And that's really important for the clients and the businesses as well.
So you've been open to changing the metric, as you get input from advisors. Like I really want like this, it's time for me to retire. I need a succession, or I want to go out and I need to buy another firm. I need to, I need a partner who's going to help me do all these things that I want to do.
Yeah. Yeah, that's where we coined the phrase life cycle equity, life cycle capital partners, right? Life cycle for the what does that mean? It means that you don't always have to be, because it's not always right for everybody, minority. You don't always have to be, and we're never, frankly, short duration. So what does it mean? So it means you evolve in reaction to the needs and the wants of the people and the businesses you're partnered with. So in the very beginning, Tony, from the time of 2017 to 2020, right around when COVID kicked into the market, how can we ever forget that? We started to realize just 3 years in that people needed a partner who could, again, as you said before, not just evolve to their cap table needs, their balance sheet needs, but also to their growth needs beyond just saying, hey, I'm going to help you with infrastructure or help you go chase wealthier clients. And what does that mean? It means putting those folks to some degree in the business we're in, right? Helping them become acquirers unto themselves, but not in a capital prohibitive way where debt
Right.
structure perhaps causes them to crumble under the capital that they're borrowing. And so there's a whole other dialogue and a whole other episode we could do on that. We won't bore people with it today, but that's really where
Right. The structure's been innovative. I think, we talked a little bit about the definitions of what an RIA is are shifting, right? So they're not necessarily just, I have an ADV, so I'm this person, right? There are a lot more choices, a lot more different types of firms. But I do think that what's driving now movement are these new ideas in financing, these new levels, and people, being open to it, advisors kind of understanding. So now that's the topic of conversation. We didn't talk about something that in my mind is one of the key drivers right now in terms of assets in motion, and that's equity. And it's one of the most flexible instruments that there is, and it's the kind of thing that will really build enterprise value for advisors. And I think that that's kind of the unique thing, and part of what Merchant has driven in the industry is this notion of equity, that there's value in it, that we're stronger together than we are apart. And for advisors to have a chance to do it, when talk about when you started things, when I started some of these things, 15 years ago, nobody wanted our equity. No one thought it was a good. They just lost. I lost millions of dollars in Citigroup.
nobody understood the nature of the private stock, Tony. Nobody
But
understood.
today they do. I mean, that's a shift that's happened.
Yeah, they didn't understand that if everybody who was unaware or criticized these businesses back then realized or took the time to realize that, I'm not being critical, I'm just, this is what it was, realize that these businesses as they stand today are the epitome of a hybrid between exceptional growth and exceptional yield, the whole market would have jumped at it back then the same way the market jumped at the long short macro world in the hedge fund industry post the crash 2000, 2000 2002, the hedge fund industry boomed. Everybody who was a hedge fund guy or gal, quote unquote, became a rock star. People charged 2 and 20 or 3 and 30, half the time sitting that long, and they built $1 billion, not even businesses, but businesses at the time. Now, today, and I'd love to debate this. It's a hard one. It's a hard argument to lose. The rock stars of the industry are the financial advisors today. They are the people that everybody wants to learn from and hear about because they've evolved into so many different versions of themselves that is what has attracted. I mean, it has attracted this inflow of capital, this inflow of technology. And by the way, some of the best, brightest, and most hard to cover family offices have moved into our space, not just for themselves, but for their capital as well.
Yeah, well, I kind of feel like in the beginning, I don't want to get too sidetracked with this, but it seems apropos. When these guys first came in, I think a lot of these people thought they were buying football teams, and they were really buying baseball teams. Like you can't just go in and this is a whole bunch of free agents that you're putting together. You know what I mean? You're managing them slightly. They're going up and down from the bigs and moving around. Versus a football team, you can go rah rah, do what I say. So I think there was a little bit of a shock to some of those guys who got in initially.
Well, can I stop on that for just a second? I
Yeah,
know
go ahead.
we're on the stream, but rolling things up, and I want to speak to every advisor, and this isn't a commercial for merchant. It's really not. Rolling things up in this industry and in many industries does not work. There are two primary reasons. One is art, one is science. And I'll argue that art's more important. Science is capital structure dictates outcomes. And when you try to roll things up with poor capital structure, you typically destroy the business because things crumble under the capital structure. That's one. And that happens all the time in this industry.
Yeah.
Sorry to say it. There's a lot of articles about a lot of things that seem good, and they're just frankly not. And again, I'm not making this specific, it's just an observation. Number two, more importantly, when you take away the identity that was created in someone's living room 30 years ago, where they drew their brand and they wrote things down and it's their life's work. When you roll that up and you take away that identity, you demotivate that individual. Growth stops, coverage stops, engagement stops. It's not good for anyone, frankly.
Yeah.
And so I think that those two things right there, to your point on the comparison between a football team and a baseball team, you can't come into our industry as capital and expect you're going to tell a financial advisor who's now a CEO, shave your head, put on my uniform, be quiet, do what I'm going to say. And by the way, I'll deal with your clients. It doesn't work.
Yeah, and that also speaks to culture being such a key element in what works and how individualized the financial services business can be because a certain type of advisor attracts a certain type of customer, so they know what they're doing. They have a way of doing it that's going to make all those guys happy. Um, we also talked, one sort of last thing I just wanted to hit on is that, people the if someone's going to say, hey, there's a knock on this, well, it's just money. Like you said, capital needs more than just, capital. So you guys have bought a bunch of other firms, not just RIA. Can we talk a little bit about the ecosystem you're creating for, folks coming?
Sure. And again, we try not to use, I'm not arguing with you, Tone. It's just one of these things where, and I know what you mean, we partner with, right? We align with, we frankly, yes, technically we're buying something, but we're partnering with these firms. And yeah, you're right. We've gone, the business has evolved not just from minority to life cycle, but it's gone from equity as a balance sheet, not a fund, to credit as well. So we have two balance sheets, and then we've taken the business in a direction where now we've taken the balance sheets, we've moved them into the essential services space, which I think is probably where you're going, right? So when you look at things that these businesses really need, right, the scaffolding of every building in the independent wealth management space, and it's including but not limited to things like investment banking. Again, not just selling the RIAs, but banking the underlying client. I mean, think of how many exceptional business owners, small, mid-size, and large, have their life's work embedded in an independent wealth firm. There's so many of those, right? And so we've partnered with Republic Capital Group to fulfill that need. When you think of compliance, right? What can put you out of business? Getting too much chalk on your shoes. So when you leave a bulge bracket firm and you don't just have to now turn the lights on and change the ink in the printer, but you actually have to manage the risk of the business, not just the capital risk, the compliance risk.
So with the compliance, what's the firm with the compliance? That sounds like
well, we're talking about just services broadly, right? So we've got compliance, and it's interesting because the firm is Advisor Assist. And the reason why it's interesting is when Chris and his wife started that business out of their garage 20 plus years ago in Boston, and now it's got 800 compliance clients and is set up over 4,000 ADVs.
Well, my point is these are well-known names. These are,
Yeah, they are well-known names. But what's interesting about that business in particular, and I mess with Chris on this not all the time, but every other time we chat, he named it Advisor Assist, not Advisor Compliance, which allows that business to evolve in so many different directions, which it has. Now they have Advisor Defense, which is in reaction not just to the SEC tightening the risk valves on cyber as a as a need. But advisors also want to be safer for their clients now that cyber has become more and more of an issue. So advisor assist now has advisor defense, and so you can go to advisor assist and get compliance fulfilled and cyber needs fulfilled. So that's that one.
Well, look, it seems like in creating the ecosystem, you're sort of answering that issue of, well, I don't just need capital. People need expertise along with, money. So, especially,
Engagement first, Tony.
yeah, especially if they want to go out and, hey, I want to go get I want to buy another firm. I want to do this here. They need someone who knows what they're doing there for valuation purposes, things like that.
Well, capital becomes somewhat of a commodity, especially when the market's saturated with it,
Yeah.
right? And so you have to be able to engage beyond the capital. There's two forms of engagement. There's advice and there's execution. I'm not knocking McKinsey, but they're really good at giving a really good presentation and telling you what you should do. However, you have to execute. And for merchant, one of the things we were and still are adamant about is we have to really know our craft, right? If you're a home builder, you walk on the dirt, you understand how to lay the foundation. You just tell the guy, here are the blueprints, go build your own home. In order to best understand that and not be in the cost arbitrage game, you got to partner with the actual supply chain itself. So from compliance to investment banking to valuation services to trust services to actually geopolitical intelligence, which is also a whole other thing, to trust, and I think I mentioned trust services. So we've got about 14, in summation, we've got about 14 partnerships, Tony, in the essential services space that are never mandated. They're always optional, and they're not just available to the merchant community of firms, but they're available to the whole market.
Yeah, well, that's great. Well, look, we're getting to the end here. Any final thoughts, about for advisors, for marketplace, words of warning, words of wisdom for form? Uh,
I my thoughts are always pretty simple, which is, hard work works. The advisor and the clients, those two groups are the reason why the firms have created value. And as one of my Rick D'Amico's father used to say this to us all the time, it gets hurry slowly. And remember, it's what can be done to you, not just for you. So it sounds like I'm selling against our own firm. I'm not. I'm just being honest, which is don't just rush at what's available.
yeah,
Come in with healthy skepticism, protect what you've built, protect your clients, and ask every hard question, not just once, but twice. And
that's great.
that's how we look at the market.
That's good advice. Well, look, Tim, we'll do this again. Appreciate you being here, and thanks for all the good comments.
Appreciate it, buddy.
Thanks.